Hey, this is Karen Rand for the Compassionate Capitalist Show. Today we're going to talk about it's just me flying solo again because I'm addressing some things that or questions that have been coming up, and I thought it just really kind of was about time that I answered the question that I get from so many, particularly young potential angel investors, what I would call millennials. Whenever I'm doing a workshop or I'm speaking about compassionate capitalism, I'm speaking about the benefits of being an angel investor, investing in entrepreneurs compared to investing in real estate or Bitcoin or the stock market. Whenever I open it up for questions, I always get this question. How do I start? I'm not an accredited investor. How do I start investing in crowdfunding companies? So that's what we're going to talk about today. And this, not not a advertisement for my book, but when you wrote the book on how to be an angel investor, you're watching, you can see it. It's always behind me on these YouTube videos. When you wrote the book on that, when you wrote the kind of how to, would you, should you, could you, and if so, this is how you do it, right? Then, yeah, I reference my book. I reference myself. And although the book is not exactly written specific to crowdfunding and unaccredited investors, it's really targeted to folks very similar to myself when I left IBM that are making hundreds of thousands of dollars a year, and or those people in the companies right now, they're executives or they're running their own company, but it might be a franchise or it might be a, a regular type of a business, and they want to become that cash flow quadrant, right side of the quadrant, business owner and investor. then then you know my book is geared towards that, right? It's geared towards that on the how to of that. So, and part of the reason it's geared towards that, I actually wrote it. If you've heard any of this before, Inside Secrets to Angel Investing, apologize, but get a lot of new listeners every week. So, I wrote it in response to the Jobs Act because after running an angel investor group for a decade plus, and the the outcome of the nature of the investors that were in my group, and then when crowdfunding, equity-based crowdfunding became authorized bipartisan approval through our Congress and signed into law by the Obama administration, by President Obama. The whole point of that, most people think, it was to make it easier for entrepreneurs to raise capital because they could directly solicit them, and not have to go through this narrow gauntlet of angel groups that primarily invest in technology and invest in things in their backyard. Uh, it also, on the other side of the coin, if you will, or the other side of the table, is the fact that that it now meant that anybody could invest in those entrepreneurs too, not just the way the rich get richer. And I talk about this, right? The greatest source of wealth historically, and like pretty much, like there's always the one or two exception, but the greatest source of wealth in the United States is to be a successful entrepreneur. But what most people don't know is that most of those companies that you know of as name brand, they did have angel investors on them. And everything that kind of built our country, railroads, hotels, telegraph systems, banking systems, all of the stuff, automobiles, innovation back in the industrial age. Angel investors, the rich were investing in each other's businesses. And that's why the Securities Act of 1933 was written, to give a way for these private investors, high net worth private investors, to continue to invest in each other's businesses without having it all out in the public and without having to report the financials and report any of that stuff to the government other than, the IRS. All right. So how to get started as a crowdfunding investor. So billions of dollars are being invested in companies raising capital directly from the public, direct public offerings in legal equity-based crowdfunding methods. And DPOs, direct public offerings, have been legal. They were just really, really complicated to do. And in my book, I talk about, in fact, how that's exactly how Ben and Jerry's, got the money that they needed to go from one or two locations to become the name brand that you know right now. Right? I tell that story in there. They did what we call an intrastate exemption, a direct public offering. But I'm going to go into that here and just as I progress. Right? But still, even though there's billions of dollars and millions of investors are investing in crowdfunding type programs, it's still far under the total capital that's raised from traditional angel investors and venture capital firms when it comes to the total amount of capital that's put into companies. But by the very nature, there is more of this kind of investing, crowdfunding investing, than traditional angel investing because of three reasons that crowdfunding offers up that traditional angel investing does. If you understand, and I talk about it in the book, I talk about how they find the deals, how angel investor groups work. Because if you are one of those types of accredited investors that an executive in a company, I give you the options of how you can play, based on your risk profile and your access to capital, your liquidity to invest. And so I cover all of that, right? This is what this podcast is, a cliff notes. But there's really four reasons why people are moving towards investing in crowdfunding platforms or companies that are raising capital under crowdfunding platforms. One, it's location. Most times angel investor groups are in the major metros. They're occasionally mid-sized metros, but most of the activity happens in major metros. Florida is a sort of an exception to that, in that it doesn't have a lot of huge cities like you have in Atlanta, you said, or LA. Miami is, and Miami's in and of itself. But if you look at all the other cities, and so in fact, the state of Georgia, under angel investors, your traditional angel capital, the state of Florida under traditional, they do about 5 times the amount of investment that Georgia does, because Georgia is very concentrated in Atlanta, and there's really not things that have started up in the other cities, because everything gravitates like a magnet, and if it's not in Atlanta, it must not exist. And so and these are just the stats. You just look at the numbers and you can tell, because quite frankly, Tampa does as much as Atlanta does when it comes to angel investing, and Jacksonville does almost. When I looked at this, because I was a keynote for an economic development conference, and I looked all this stuff up, and of course it was pre-COVID, but Tallahassee had done $12 million, right? He would have thought that Tallahassee would be such a thriving angel investor community. Okay, so to my point, it's because of location. And so when you're outside of it, and people have a desire to invest in entrepreneurs, or invest in entrepreneurs just in their town, it's really difficult for them to find the groups that would do that, or even, and particularly if they're trying to do something that they want to, really put their money back to work in their local community. There's a whole other things of initiatives that are around that. But so location. Number 2 is time. A lot of people that would be angel investors are like the target market that I talked about for the book, and even particularly millennials. And I'm defining that more by age. But if you're looking at somebody that's in the early part of their career, 25 to 35 years old, in that space, making $100,000, $150,000, $200,000, they're not an accredited investor, but they also don't have time. They're working a lot. People that are 35 to 45 or 50, they've got kids that they're growing up, right? They're doing activities with their kids. They don't have the time that angel investor groups require you to put in, because almost everything's done by committee. So you have to volunteer. You have to show up for the meetings. You've got to spend hours once a month at these meetings to see the pitches, and you have to be a part of the committee, either screening them or doing due diligence or something else as part of that, rotating through. And so if you don't have a lot of time because of family, or you're traveling a lot because of your job and stuff like that, then the angel groups don't really fit the bill, but you still might have a desire. And then there's the exclusivity of it. When I was rebuilding the network of business angels and investors, when I had taken it over from Jerry Martin, and I knew what I wanted to do, I wanted to be able to bring in investors. I've always wanted to bring more investors into the game. Okay, I always wanted to do that. The song that I play as part of my intro is excerpts of a song my daughter wrote called "Pieces of the Game," and I always thought that was really clever, because it is a game in a way when it comes to what entrepreneurs have to do to raise the capital and what the investors put them through with that. Um, so there's a certain exclusivity, and I reached out to the angels that were known entities in the Atlanta area. And I said, hey, will you come in and do some stuff and teach and mentor my new angels that are coming in? I'm trying to attract people that maybe they own their own trucking company, or maybe they own their own plumbing business, but they're worth millions of dollars, and they could be an angel. Maybe they're a farmer that's worth millions of dollars, and they would love to be able to invest in ag tech, or they would love to be able to invest in water tech or something like that. They would love it. They would know the space. They would know the things like that. When you do that, they go, nah. I don't know. We do technology, and if they don't know, then they just have to learn. And part of that was because when I first got started and I was interviewing all these investors that I met through, helping Jerry run his groups, I had like 3 questions I would ask them all. And the first one was, how'd you get started? And how'd you figure this out? And what was your greatest, what was your biggest mistake or biggest lesson learned, or something like that, right? And I actually even did surveys where I mailed them out to investors and things like that. I have all that data in my drawer. Anyhow, they would say, well, a friend invited me. Okay, so that's another highly successful person invited them. 2, I didn't really know what I was doing. I mean, I thought I knew because I've got business sense, and I was, I had my own company or was an executive in a company, but I didn't really know exactly what I was doing. And I lost money on my first 3 deals until I figured it out. And then I have this list. This is whenever I advise companies on what they need to do to communicate to investors, or whenever I help investors with their due diligence. I know those things that are on the hidden checklist, right? And so I would say, they would say, yeah, and so I have this, these are the things I just won't ever do anymore. And a big part of it was emotional decision, and not going through and asking all of the tough questions, or the questions you hadn't really thought about, or you just assumed something, right? Instead of, because what they write in a business plan is different than what they put in a PPM, because by law they can't forward talk. They have to be just the facts. And the private placement memorandum is always kind of a Debbie Downer, because it's supposed to be all the risks, all the things that how you might lose your money if you invested in this, right? And people don't like to read those. They like to read the business plan that has all the sizzle and all of the exciting stuff and all the things that they're going to do, but they don't even really ask if they actually know what the actual costs are going to be. I mean, I'm not going to get into that now, but, and the fourth thing is accredited status, right? So traditional angel groups, you have to be an accredited investor, which means, that you have to make $250,000 a year for the last 3 years, as a single person in a household. As a dual income, it's 375, I think the number is, for the last 3 years on your income tax, or be able to show your net worth, or have certified. There's 3 ways you get certified as an accredited investor. I also talk about it in the book, but it's somebody certifies that you are somebody who's licensed, like a lawyer, accountant, financial planner, wealth manager. If they submit a letter that says you're accredited, then that counts. You submit your tax return. You do similar to doing applying for a mortgage. You submit that information, or you submit your total assets and liabilities, which is the least favorable thing for investors. They don't want to disclose all of that information. So the easiest way is to get the letter, right? But on most of the Reg D offerings, the responsibility of that is on the investor. So investors in angel groups, or particularly these online angel groups, they routinely will just sign the paperwork that says they're an accredited investor without having to produce anything. The only way you have to produce anything in the crowdfunding realm is under Reg D 506C. That's where you have to prove that you're an accredited investor. Anything else, you don't really have to prove it. Now, really legitimate angel groups will require that proof and not just go on your what you say, because they're trying. A lot of service providers will come into those, or finders will come into those things and say they are. There's groups in Atlanta, and I just get a kick out of it because I know that person's not accredited. But because I say I'm not accredited, I mean, I'm technically I am, but I don't want to. I don't want to oversell my capacity to make a consistent angel investing, kinds of stuff. A lot of my money is tied up right now, waiting for exits, and I'll be back in the game when I have those exits, right? So I'm always very transparent about that. So they don't let me in. They won't let me in. The guy that runs the Keiretsu Forum here in Atlanta won't let me come to the meetings, but I know of at least 5 people that go to the meetings on a regular basis that lie. They are not accredited. They're not there to invest, but he lets them in, right? And so, it is what it is. I don't care. Any deal that needs my help, I will help. It doesn't matter where they're trying to raise their capital. But anyhow, I digress. So those are the 4 reasons why, people are doing the crowdfunding rather than doing traditional angel groups. Okay. They want to be included. They want to have authority over their decisions. They want to invest in the things that they really like and have a passion about, compassionate capitalist. They have the flexibility to do it, to look at deals Saturday morning, late at night when they're trying to go to, wind down for the day. They can attend the pitch event and then do the follow-up. It's all on them in their own time frame, and they can do it anywhere. If they're in a hotel room someplace away from home, they could be looking at companies that are raising money under direct public offerings. So, but as with anything, those out there that want to know how to get started with crowdfunding investing, you have to learn about it first. You need to spend some time understanding the business models of the 5 different ways to raise money directly from a crowd. And I'm going to talk about that. And I have other podcasts that maybe I'll link in the show notes that compare these different things and do some other, how they're interrelated to each other, how you can use different. So some companies will be using one method as a launching pad to another method. And that's important to understand, because one of the rules of deciding this company is a better investment over this other company is to know that they can raise the capital, right? And are they savvy about that? That's one of the things that is on my 11 points when people hire me to evaluate the deals for them. So you got to do that first of all. Okay, I recommend that you have a binder, and in one section of it, I use just sticky notes sometimes to separate it out. Like this is one of my binders that I'm doing work on, right? And so every time I talk to somebody that gives me some information, or I attend a webinar on something I'm trying to learn about, I write the notes and I put a sticky mark out next to it so I can find it, because it's just a spiral notebook, right? It's just an easy way for me to do that. So for those that aren't watching, so basically it's the little tab ones that are kind of clear that I just have in my folder, and then I can flip to wherever that topic is and continue taking notes. And my questions, if I have questions, I write a question down, and when I find the answer to it, I write the answer underneath the question. That's my nerd in me. Okay, that's the nerd in me. Get my book, right? That's the other thing. Even though it opens upside down, Inside Secret, only one. I know somebody who puts books up upside down. Inside Secrets to Angel Investing. You can go to Inside Secrets to angelinvesting.com, and you can get little excerpts from it. You can find out what's on the resource portal, because you get a resource portal that has tools for this stuff. When you spend that whopping $20 to get the book, anyway, you can go to Amazon and get it. If you go to the Inside Secrets to angelinvesting.com, there's a link to the Amazon link. If you get it, please give me a good review. And there's also the ISBN number that you can order it through your other bookstores if you want to just order it from your one down the street, or you like, Barnes and Noble or something better than Amazon, you can get it there. All right. So take notes as you're going through this. Now, at the end of each chapter, it's got, here's exact steps. So take the notes. Take your notes of, all the things you learn. Watch some of my videos. There's some other people that are really good at talking about this kind of stuff. I highly recommend that you keep the tone of whoever you're listening to is somebody that is geared towards somebody who's starting out as investing, because a lot of traditional angels, as I gave that story at the beginning, they have sort of this blinder on that everybody must know what they know. And, they don't really think about what people don't know. And it's one of the biggest reasons why angel investor groups struggle to, they bring in new members, but the new members aren't investing right away because they're uncomfortable with the process. They're not familiar with the process. It's a whole new thing. And, you've got to, in order for them to write the check out of their own checking account, they need to be able to feel really comfortable with that. And that some angel groups use my book as a primer. I've had, them buy cases of it, and they give it out to all their members, because it's really the only way they can get training on a DIY basis, without having to wait for Kaufman to provide education. So, or, they get their members to come in and do it. And the most successful members can, but then, maybe they're going to go back and watch the video or something like that. But, anyway, the book is really the key way. And that's why I wrote it. Some of the other ones, I love Jason Kakanis. I think great that he wrote the book, but it's really geared toward, he had a unique experience in him being a tech entrepreneur and being in Silicon Valley. That's not the way most of the rest of the world operates. And that's not how most angel investors get started in this. And David Rose's book is really good as well, but it's really geared towards fine tuning and getting better at the art of angel investing after you've already done some. Mine is really geared towards how do you get started wisely to mitigate your risk and not, and really try to avoid the deals that suck, right? Or make, what people say in hindsight, if I'd known that, right? I never want to say the stupid mistakes, because it's always a lesson learned. So, okay. So similar to angel investing as a business angel, okay, this is what you have to do if you're going to invest in crowdfunding things. Very similar. Here's the similarities, and then we're going to talk about the differences. First of all, what is your avatar? I call it that. There's your prospectus, your profile, your whatever. You feel there's a word for it. I probably need to invent a word for it. Avatar is not the proper word for it. They use this in real estate, and I can't really think of the word of it. And so basically, you need to figure out what type of company or industry are you interested in. Just like Warren Buffett, invest in things you know. If you have a certain, if your job is in a certain industry, and you know things about your industry, what is it that you know about your industry? What are the weaknesses in your industry? What are ways that they could improve the industry? What is something that's novel that could happen and shift the industry? What is it ripe for, right? So that's one thing. Second thing is maybe what's your hobbies? What are your hobbies? What are the things that you're passionate about? What is it that you like to watch? If you like to watch science shows, or if you like to read certain kind of articles, what is it that you're interested in that you have an above average knowledge of, that you've gained over time because you know that, right? You could be a little league coach, right? Maybe there's something in the space of sports tech, right? So you understand the things that figure out the things that you know. So you understand that. That's your first level, right? So you're going to look for companies that are in that space. And then when you say, oh, there's a company that I really I really wish there was something like this, right? Then fine. When you once you say that, the odds are there's somebody out there trying to do it, right? And but then when you find a company that you like, right, then you have to decide what stage do you want it. What's your risk tolerance? So idea stage, which is the most risky. Are they into revenue? That means that they've figured out that people want their product. Their product is people are buying their product, and they're now seeking capital to grow. And then there's the growth stage that says they're millions of dollars in revenue. They're profitable, but because of what they want to do, bring out a new product, take that product into new industries or new sectors, they're not able to get the capital that they would normally get from maybe they raised an angel round but didn't get the VC round, and so they're too small for private equity funds, which usually is about a minimum of $10 million in revenue and about a million and change in EBITDA for private equity even to look at it. They're way beyond, not even going to hope and a dream of a hedge fund, right? So their access to capital is tough, and so they're doing direct public offerings. They're doing these offerings, which I'll talk about those in just a second and what kind of companies. But so you have to decide where's your risk factor. The potential return on investment is higher the riskier the deal is, right? The less amount of risk, just like when you buy a public stock, the odds of a public stock going up significantly are really low. It's not going to happen because they've already established much of their value. And so they only nudge up as a result of quarterly earnings and announcements. And all of a sudden people want to buy their stock and other people want to sell it, and it causes it to increase in value. That's the way stock markets work. And so when it comes to private companies, they're usually, I always say, buy wholesale, sell retail, right? So when you're buying equity in a private company, you're buying it like it's wholesale, with the opportunity for it to grow in value, and then you get to sell it at retail. You're not actually selling it. Well, when the company goes public, you sell it at retail, or when they get acquired, they're going to get acquired at some multiple of whatever their value is based on their EBITDA or the industry rates. And that would create their stock value to be significantly higher, that equity price of that share, than what you paid for it in that undervalued state. Okay. So private companies, for example, for those people that love pink sheets and OTCB, and they want like the penny stocks and all that kind of stuff, your best place to play in that is with crowdfunded companies, because you can play with some of the same amount of dollar amounts, but the difference is that they're going up, whereas with penny stocks, reverse mergers, OTCBs, they could just sit stagnant. And I got some stories to tell you about that, Han. Woo! Anyway, they can just sit stagnant because they don't understand that they are their market maker. Nobody's paying attention to them. So just because they announce a quarterly earning, nobody's going on CNN and saying this is what the quarterly earnings were, right? They have to do all of that themselves. But guess what? When they're raising money on one of these crowdfunding platforms, they're doing all of that. They're doing all the work that an OTCB, reverse merger, any pink sheet kind of company would be doing. But they don't, most companies, they just don't understand they can't stop doing it. But the good news is that when they're a private company, they still have the option to be acquired and for you to get bought out by this as the shareholder, which if they're acquired as a public company, it doesn't really make any difference to you as a shareholder. You convert into the other company's shares. It doesn't really make a difference. Okay. You might they always talk about, like in the Twitter thing right now, the price is going to go up. So yes, those people would get an exception, but as soon as they're going to be locked out, you can't sell the stock right away. So just like a lot of these unicorns that go public, Snapchat, Facebook, name them all, they go public and they have a strike price and they immediately collapse. Well, that's because those angel investors are able to sell their stock, but there's not enough demand, and the market makers that bought it, the investment bankers that bought it, are now selling it, and it's driving the stock price down. And they don't have the normal businesses and the stock value. That's a whole nother conversation about unicorns. I talk about it in the book. They don't have the stock value to sustain that until they do quarter releases and all that other kind of stuff, right? So got to know your stage, type of offering, right? Third thing, right? When you come up with your stuff, and in the book there's a worksheet to work this stuff out and score companies on based on this, right? So then your type of offering, is it going to be a debt finance? Is it bridge financing to something else? Is it something that they're, so they're just bridging to the next wave of capital, or it is some kind of convertible that says you're going to accumulate interest on this, and then it's going to convert into an institutional round that gets a stock price. So that may work when I get into the types of crowdfunding. I'll come back to that, of how that might work depending on how they're integrating the use of the direct public offerings. Is it a straight up equity, right? Is it straight up equity? Equity is where you're buying the shares of the company. They're non-liquid, you can't sell them, and you sit on that until that company has a liquidity event. All right. So, and then there's the revenue model, where you're investing in the company and they're paying you a percentage of revenue until some multiple on your money has been paid, that's been agreed to, and you don't really own any equity in the company, but they're obligated to pay you. Everybody, Mr. Wonderful, that's Mr. Wonderful's model, right? But we call it royalty revenue financing, or royalty financing. And it's a great program. I talk about it in the book on how to look for that, how to get involved in that. So so let me go back to those three things: debt, finance, equity, and revenue, right? So we'll come back to that as part of the things, and I'm going to talk about the platforms. All right. So then, understanding the types of crowdfunding. So first of all, reward based. That's the one that was out there for decades, even before equity came about, right? Been around everywhere. And part of the reason for the Jobs Act, when you take it out, like for those that are watching, the fidget widgets, right? Little fidget widgets that were all rage for a while. Well, the fidget widgets were originally a reward-based product, and then it got into consumer stores and stuff like that. You also have smartwatches, right? The smartwatches, 3D printers, drones, VR things. I talk about this in the book and in the relation to crowdfunding. All of those came to market under reward-based crowdfunding. Individuals paid for the prototyping, the manufacturing, all of that, to be early adopters of those technologies. And then once they got into the market and they showed that there was a opportunity for this, then the equity-based ones, VCs came in, all that kind of stuff. But those people that put in millions of dollars to get those products early did not receive a single dime or any benefit when that company went on to raise $100 million and sell for $300 million or whatever, or sell for $1 billion, as with Oculus, right? They didn't receive any funding, any benefit. That's the other side of the equation of the Jobs Act, is that anybody can play in the American dream to be that investor that invests in those entrepreneurs. All right. So the first one was reward-based. Reward is still out there, and reward is really a great way for a company to validate. I recommend this when you're going out to traditional angels, but even when you're trying to consider doing another form, because if you can raise money to get your product fully formed and ready for market, and therefore you have validated the market without giving up any equity. Right. So it's a good thing for entrepreneurs to do that. As investors, it's good to know the history of what the company has done up to this point. The second type of direct public offering for equity. Now, the next four are equity. Intrastate exemption. So prior to the Jobs Act in 2012, just prior to it, okay, uh, Kansas and Georgia were actually the first states to adopt interstate exemption. And what this is when a company in the state that's headquartered in the state, they're either structured and they have their operating agreement, all of their organizational documents in that state, or it can be a Delaware company operating that state, but they are headquartered in that state. They can raise money from investors that live in that state, and they can be accredited or unaccredited. There was some heartburn on this when it first came out because SEC wanted to say that they weren't allowed to do that because they would still be using federal mechanisms that they were sending out on email or using the internet to advertise or driving on the highway. It was a real stretch, but it was really the SEC just couldn't handle it at the time. So states started adopting it and put different kind of characteristics on it. It was limited to $1 million at the time. SEC came out with rules on it, and they basically modified the Reg D 504 because it was already set up where you could have accredited and unaccredited. You were just limited in the number of unaccredited, but it was, you could rate, they put it at 5 million. So now SEC blesses it in a state. Most states have different rules associated with it, like you can't do real estate with it, or you can't do certain kinds of things. And there's, sometimes they have angel tax credits that come with that, and they'll be tied to that. So I would highly recommend, if you're interested in getting started, go find out, look up interstate. If you get my book, there's a link, but look up interstate exemption, your state. All right. Whatever that state is. And it should come up. In Georgia, it's actually really kind of hard to find because it's buried down in legislation stuff. And there's really not anything that actually explains it really well. Hence the fact that I could probably count on two hands all the companies that have used it in Georgia to raise capital. It's just, it's really not something that people really use it, not even aware of it. And it's been around since 2012. So 10 years. All right. And so that's something that's really good. I think it's a great thing to offer up for companies that are trying to attract they want to franchise, they want to expand. They're currently manufacturing offshore. They want to bring it on, into to beat the supply chain, to take advantage of other tax credit programs. They want to bring it into their state and build their own manufacturing facility. Well, why wouldn't all of the members, the high level people of the Chamber of Commerce and all the local businesses, this is an established business that's doing great, they're profitable, and they want to create more jobs here. Yes, let's invest in them. Let's give them the 5 million, right? So lots and lots of people in that state, that community, give them the 5 million, that then a bank will give them 15 or 20 million for their equipment, because they have this money for their marketing and their people and the soft dollar stuff that isn't tangible asset that you can finance. One of the ways that I help companies figure that stuff out is putting that kind of stuff together. So interstate is great for that. Interstate is also really good as a stepping stone to get the funding that you need, because you might have an angel group in your state. This is one of the things I propose to angel groups, right? Use an interstate exemption, so to give them a convertible number, a note, a debt facility that will get paid off when they raise this next round under a Reg CF, perhaps, or a Reg D 506C, or a Reg A plus. Okay, so what happens, the common thing of the next three, Reg CF, that's Reg crowdfunding, Reg D, which is all of the regular exemptions that were under the securities law of 1933, 506C versus 506B. 506B is the way regular companies raise money from angel investor groups if they're not doing term sheets, or they're doing the old private placement memorandum. They have to know that investor. They have to have a relationship with that investor. They can't just email it out and blast it out. Okay, that's under a Reg D 506B. They can raise unlimited amounts of money on that. But under a 506C, they can solicit across the country. They can broadcast it any way they want to, but the only people that can invest in it are those accredited investors that prove that they're accredited investors, right? So it's great. And if they do that, they cannot go back and do a regular 506B. So there's a limit. They can do Reg CF along with their 506C, but they can't go back and do traditional capital raises. They can do interstate along with 506C. And then Reg A Plus is the one that modified what was out there under Reg A before. Okay, so they basically, the SEC just kind of took the existing methods and tweaked them to be this direct public offering. And so Reg A had been out there, but it was, and people liked it because you could test the waters. You didn't have to, you could test the waters in a state and decide if you're going to have investors. So broker dealers, large broker dealers, investment banking firms use this to raise capital for banks. A lot of banks got raised capital this way, things that might have a national charter, and they could test the waters before they file paperwork with the Secretary of States in those states. And that was an expensive process, but it was really geared towards, up to $50 million. Okay. So when they made Reg A Plus, they said you don't have to file in the states, but what you do have to do is give the SEC audited financials, like you're going to be a public company. You have to have financials that are like a public company, not just comments, but like a public company. And then when you get that, then it's a back door, it's a way in to becoming a public company without doing a reverse, without doing any of those other things, because now you've got the momentum of a national brand, a marketing campaign to raise your capital, and you can likely get picked up by a market maker that's going to promote your if you do decide to go through the whole public process. You don't have to, but you do decide. All right. So Reg CF, interstate Reg CF, and Reg A Plus, anybody can play. The only limit is how much you can invest based on your income. And so if you're not an accredited investor, the most you can invest in a year is $10,000. And so you divide that up, but that's plenty, right? Depending on what you do. And so I always believed that an angel investing was going to be the sort of the new black, if you will, the new little black dress, the new black, in the cool thing for millennials, because their money is having an impact. They don't have the same hunger for all of the strappings of showing that you've made it, if you will. They're okay with driving a less expensive car, because guess what? They could go put 10 grand instead of into a car. They could put it into companies that they really believe in. They believe in their mission and stuff like that. Okay. Only one of those platforms require a portal or any like licensed entity to look at it and validate it. And that's Reg CF. Now, some of the interstates, some of the states require it. Like, for example, I did an interview a while back with the CFO, if you will, of Florida. He's trying to get their interstate exemption laws changed, because we've only done maybe a dozen in Georgia. They've done none there. And the reason why is that they require a portal, but they haven't authorized any portals in the state. So he's trying to get it to change. So a portal that's operating in Texas could also do Florida, for example, right? There is a company that does that I don't remember their name, but they do Reg CF, and then they do in certain states that authorize them to be able to do that. And so I worked with them in Illinois when I was doing a project in Illinois. And so we were doing a combination Reg CF and interstate kind of a thing. And it was really a fascinating kind of model. But anyway, they review it. So when you're looking at these companies, if you're going to get started with Reg CF, that's a great way to cut your teeth, because at least you know that these companies have gone through a screening process and they're getting all their paperwork filed properly with the state. Because when you leave it up to the entrepreneurs, you don't necessarily know, are they filing the right paperwork? And if you haven't taken time yourself to understand that, they don't say it. If they've got good legal representation, they will have filed paperwork properly in theory, otherwise they're on it. But I always recommend anybody I work with, if they're not going through, some broker dealers will do this now. It used to be broker dealers would not touch private deals, but they're now starting to do that because they have their own portals for the 506Cs, right? That they do. Um, and so, they may, if they're going through a broker dealer, you need to, but if they're an online portal, so odds are they are doing some kind of screening, but you should look at that and find out what is their screening process for those companies. What do they validate? How do they look at their financials? Do they do background checks? All of that kind of stuff. If a company is not raising it through a portal, they should have a password access page. They have public information that's like their executive summary, maybe part of their pitch deck. And then they have a proprietary thing that's confidential so that the investor has to document are they accredited or not accredited? Depending on the type of capital raise it's going to be. Are they serious? You want to, before you start passing out all the information, you want to make sure that they're serious and they have the capacity to invest. They're not just picking up your business plan for information purposes to learn about an industry or something like that, right? And so, or learn about a potential competitor to something else that they're investing. So you want to have some form of a hoops that you make them jump through to get to the rest of your information. And then you need to be very transparent. The presentation or the podcast I did 2 weeks ago, I talked about communication and transparency. And so the company should be providing this information as if they were a public company, because unlike traditional angel groups will meet the CEO and the founder. They'll have follow-up things where you will talk to them, because they're going to be coming in and making an investment all at once of 250, 150, 300, $400,000. So the entrepreneur will spend that time. But when they're raising $1 million from people that are going to spend $2,000 a piece or something like that, they're not answering all of your questions individually. So you need to make sure that their information is on there, or they have a mechanism to answer your questions, a form to fill out, that they're together on it, right? That they understand the process. Because if they understand this process and what the investor needs to know, then it comes to the other big question that is part of what I talked about last week. Do they have the ability to raise all the capital they need to succeed? Okay. So Reg A Plus companies should be companies that are well into their revenue stream, that are raising growth capital, that they're looking to become a national brand. There are some people that will set up a Reg A Plus company that's a startup with no revenue, because technically you can. But I would never, ever, 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 ever invest in a company under Reg A Plus that is a startup seed stage company. Just saying it, right? Because the amount of money that it takes to raise money properly under Reg A Plus, they should be spending $100,000. So how are they doing that? So they're trying to do it because they think it's an easier way to do this, rather than raising the 5 million that's available under Reg CF. They don't want to go through the screening of a portal, right? They could get paperwork filed with because the SEC doesn't say this is good or bad. They just say, yes, they filed the proper accounting paperwork. That's all they did. It's a yes or no checkbox, right? It's perceived to be better, but it's really on the company to be able to position themselves to be as compelling as a public company, yet they're still wholesale, right? That's the messaging there, because they got a great story to tell of where they're going to go from where they are right now. And if they're a startup, if they're a seed stage, they do not know this. They don't know. They don't know if it's really going to manufacture itself in a month. They don't know that an entrepreneur or their target customer is going to make a decision in a week. They don't know that because they haven't started selling it yet. That's why it's the most risky, but that's why you also make the most money when that number, like Amazon, when they first started raising capital and they were an unproven people buying books online. Who knew what they were going to be like today? I mean, I think Bezos knew that. He had an inkling of it, but he started out, I think, and I talk about it in the book. I think he started out at 25 cents a share, maybe 15 cents a share. And he sold it to friends and family, his parents' friends and family. They had some money, they were involved in the financial markets, and and he painted the picture of what it was, and it wasn't, and the other number one rule, and I hadn't said, hopefully you're still listening, is don't invest anything you're not willing to lose, because as best as you can, there's is never a guarantee, right? Never a guarantee. I mean, the one thing that real estate has over investing in entrepreneurs is that the land will always be there, and or the building will always be there. And you may lose your shirt on it, you may lose money on it, you may do things because you didn't have the right team when you were buying it like that, but technically it's still there. So if the bank doesn't take it away from you, you still own it. Okay. And eventually it'll raise up in value. Well, you don't necessarily have that when it's a company. And that's the biggest problem with Bitcoin and some of the stuff they do on Bitcoin, because there's not a company there. It's just this digital currency. And so when you investing in companies, you're investing in the founder, the idea, the mechanism, the team, the unique value proposition, these kind of things. And you can do that. Most Reg CF are going to be seed stage, but they're also usually raising, because the thing is that if they don't know how to raise their capital, they can't get their money. You get your money back when you invest in a Reg CF company, because the company that's offering it up on their platform, they say they're going to raise $100,000, let's say. Used to be people would go out and say, I'm going to raise $1 million, but then they'd only raise 100,000 and they wouldn't get their $1 million. So now they say, I'm going to raise them $100,000, shooting to raise 2 or 300, because they know they can get 100,000. And then they get their 100,000 and they use that to facilitate raising that next 500,000. And so they use it to get the money to do the next thing. And so, when you're working with a company, a lot of these platforms, we fund, no, see, they allow you to do like 5 capital raises in a year to get to that total limit of whatever the limit is that's according to the federal regulations, right? So that's the thing I do. I didn't go through, there's so many crowdfunding platforms out there. I would look to really validate them, look at the kind of companies that they present. It's also, what do they do to help the companies raise capital? Because my big beef a lot of times with most of these platforms is that when the company drives traffic to their platform, they don't own that relationship to follow up with that person to answer their questions. If the person gets there and they don't really get it, they don't really know, then they go to the next one because another one pops up and another one pops up. Now their relationship is established with the portal, and the portal is sending them the deals that are getting a lot of traction. And there's a whole nother art to another podcast for how do you get traction and how you raise capital on that effectively. But that's not for today. This is for those investors out there. So you need to sort of understand. I recommend signing up with at least 3 portals. Find 3 that seem like you like the vibe, the kind of things. And some of these will offer this near public stock. Okay. So I think Republic does it. Maverick, no, it's it. They do that, and the way they get their shares is from employees that have been in those companies for a long time, 5, 6, 7 years, and now they're getting ready to go public. They can, before they get into their dark period and they can't sell it, they will sell their stock. They're authorized to sell their stock at a discount to whatever the strike price is going to be. So that sophisticated investor can come in there, and it's really only for accredited investors that they allow this, but they can come in there and buy the stock, and it'll say on those particular websites what kind of companies: Reg CF, 506B, Reg A plus. right? There's a number of them that are specialized, some that just do Reg A plus, which is probably your better bet if you don't want to get into the seed stage type of companies. If you are somebody that I would seek out who's doing the intrastate. And sometimes when you go to some of these forums, you can plug in to a forum where they're doing pitch competitions at the local incubator and stuff like that, and find out who runs that. Any of these companies doing it under interstate exemption, right? So you can look at it and you can fall within. If you're not an accredited investor, you can still play in the game, right? And recognize that if you're on a platform, they're going to take a fee, 5% to 8% of the money that you put in is going to go to them. But that's really no different than what a broker dealer would charge. And anybody that's actually involved in raising capital for that company, they should be raising capital through a license. If anybody's taking they should not be taking a commission unless they are licensed. There is an exemption for that for people that are doing investor relations and raising capital for some of these direct public offerings. They can get paid a percentage of what is raised, but it's a narrow box on that. So, hey, hit me up with some questions that you have. I'm working on building out a course to go into this in much more detail, and starting to offer that up. And any questions that you might have would be great. If you go to the karenrands.co/blog, right, you can see the all of the things. You can do a search on crowdfunding, and you can see all the podcasts I've done on crowdfunding. um when this goes live on there, you can sign up under the contact page and fill in your question there, or when you get the reply back, set up a link on my calendar, and I'm happy to talk to you about this if you are looking to get started as an investor and just really kind of want to know, you know or you started looking at deals and you're kind of frozen in your process because you're not really sure what the next step. Hey, I would love to talk to you. So with that, I'm going to say I hope this was useful. I hope it created a lot of questions, because you should have questions. I should not be able to answer every question in the 45 minutes that I've been talking. um, that would be, you need more questions. So but if you have friends that have been talking about getting started in crowdfunding, uh I I mentioned Jason Kakanis. One of the things that I realized that, like, millennials need this information. He said that when he was interviewing the founder of Seed Invest, he said if I could do it all over again, I wouldn't have started my first company at 22 or 21, whenever he was. I would have gone and gotten a corporate gig with a guaranteed income, benefits, all of that. And if I knew what I know now, and I could talk to myself today as that 21-year-old, and I would start putting $500 a month into a company, a Reg CF company, every month. And at the end of the 5 years, when I would be vested and be able to be eligible for my stock options and things like that in my company, and they would be matching my 401k, I would have spent $30,000. Is that the right number? 500 times 12. Yep. No, $18,000. Sorry. No, 5 years. Yeah. 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 $6,000 5 years. Yeah. $30,000. Okay. I would have spent $30,000, which, by the way, is the average amount that a accredited business angel puts into a company, one company. So just kind of putting this perspective. But I would have put $30,000 in. I would have invested in 60 companies. Okay. And I think that's the right number. I think I'm doing my math right. I'm doing it off the top of my head. And out of that, if you just do the math that all the investors talk about, that says for 10 companies, you're going to have 3 that suck, 3 or 4 that do pretty good, okay, 2 or 3 that do really well, and 1 that hits it out of the park and makes up for all the others, right? And those with all the resources and experiences can't pick the 10 of the ones that are going to hit it out of the park. Then right? So let's just use that same number. If you had 60 companies, right, you would have at least 5 companies that gave you 10 times your money and made up for the other ones even if they liquidated in that 5 year time. But you're going to have these other ones along the way in between and things like that, to make up for that, but whatever that number is, it would be a lot more, right? So you put 30,000 in, let's say you made, you still have money in these other ones, right? They haven't all gone out of business, but you will have made $20,000, $30,000, doubled your money, which is a lot more than you would have gotten in your company 401k if you've been putting that in every month at $500 a month. At that, you would have 32,000, 33,000, the 30 you put in plus another 3,000 over that period of time, maybe. All right. So I was like, wow, I never thought of it that way. Okay, I get it. And I need to be helping these millennials that are thinking that, and these executives that are thinking that way and want to get started. It's a great way, low cost way to get started and start figuring out what you like, how things work, right? Without risking the $30,000 in your first investment. So with that, onwards and upwards, welcome to the compassionate capitalist movement. Let's go start getting rich, investing in entrepreneurs, and bringing innovation to the market, creating jobs, impacting our community, and creating wealth for all those involved.